Okay, on to the next episode today. Alright, guys, this one will be slightly long and interesting. Okay, so everybody talks, about the tier one banks, hedge funds, A bulk, B bulk, but behind it all, there's a player nobody escapes from. Okay, which is the central banks, the so-called lenders of last resort, the hidden hand behind every liquidity cycle. And the truth, they are not just referees, they are they are the active players. Okay, so today we are going to cipher their role, their hidden powers, the central banks, the hedge funds, the multinational, the MMCs, multinational. Okay, and also the role of the interbank forex market in itself. So central banks, so what do the central banks actually do? Okay, they aren't just printing money randomly. Okay, basically they have three main jobs. Okay, which most of us are actually familiar as a trader: monetary policies, which includes like interest rates, QE, QT, or foreign reserve management, FX intervention like SNB, like Swiss National Bank defending euro against CHF. Okay, until like 2015, and the lender of last resort. Okay, so basically they decide who lives and who dies in a crisis. So during 2008, the Fed didn't just save US bank, it secretly funneled trillions in swap lines to the ECB, Euro Central Bank, BOJ, Bank of Japan, and even the SNB, which is the Swiss National Bank, to keep the global dollar system from collapsing. Okay, your local economy, it survived because the Feds let it. Okay, so this is the reason why if your country are below the leaderboard, you're not in the top 30, 40 countries, sometimes you really can't do much because the top 20, 30 are moving too fast. Okay, your country just couldn't really adapt and catch up to the speed in itself. Okay, so central bank is the liquidity pyramid in itself. So you can think of tier one banks as the distribution mafia. Okay, so they provide liquidity, but only because the central bank allow them access to the reserve. Okay, so the MNCs calling JP Morgan for Euro USD swaps. Yes, but like the JP Morgan's pricing is directly influenced by the Europe Central Bank rates, the Fed swap lines, and the BOJ interventions. Okay, so technically speaking, without central banks, tier one banks would cannibalize each other with central banks. The whole cartel is then stabilized. Okay, so the Fed basically also has a secret tier list. We call that the primary dealer, about 24 banks that get direct access to the Fed liquidity. Okay, everyone else is just a downstream, the hedge funds, brokers, even the governments. Okay, they're just outsiders. So on the future, we'll go more onto these topics, which is honestly interesting. You as a trader should be hyped about these topics. Okay, so on to the next, which is the currency wars and the silent intervention. Okay, so if a trader sees a Euro USD move 100 pips, okay, and they think it's the technicals, okay, okay, in reality, half the time is central bank shifting reserve, rolling swap lines, or shadow interventing. Okay, maybe some examples is the BOJ stealth intervention in USD JPY. How they don't announce every move. Okay, but Tokyo 3 a.m. candles tells you the story. Okay? China's PBOC, okay, runs a managed float, officially free, unofficially one of the tightest controlled currencies. Okay, this is with China. And the Swiss National Bank in 2015, which is the euro against the CHF floor, they promised unlimited intervention, then suddenly dropped the peg, wiping out brokers and traders overnight. So central banks, they share intelligence. Okay, the Basel, the BIS, it's like the cartel's clubhouse. Okay, they meet every 2 months off the record and declare or decide the next phase of liquidity globally. Okay, so retail, don't bother, okay, we'll never get the memo, okay. It's always the same case. So basically the central banks and us, we as a trader, why does this matter, okay? Because every peep you fight for is against central bank engineering, okay. So when you see spreads widen or the liquidity dry up, chances are the central bank has changed the plumbing upstream, okay. So you're not trading against the market, you're trading against a system designed and backstopped by the central banks. So next time when someone tells you the market is free, just remind them, okay, the market only exists because the central bank keep the illusions alive, okay. They are the puppet masters, okay. They set the tone, they pull the strings, and then decide who eats and who starves, and on to the next, okay. We're going to connect this directly to hedge funds, MNCs, and tier 1 banks, okay, the lieutenant of the central bank empire. So how these players interact inside the interbank FX market, and why your stop loss is nothing but a data point in a much bigger game, okay. So we break down how money flows from hedge funds and MNC into tier 1 banks, okay. So how those banks provide the real liquidity in the interbank market, and why every trade you place is essentially filtered through this hierarchy, okay. The next one, which is we're going to talk about, which is the interbank FX call, okay. So just imagine the interbank forex market is literally the real market, okay. We can't get our hands into it, okay. So who can get access is usually only the tier 1 banks, JP Morgan, Citi, Deutsche, UBS, Barclays, you know, only them can directly trade here, okay. So this is where the spreads are razor thin, okay, often, you know, fractions of a pip, and liquidity is the deepest, okay. Tier 1 bank quotes to each other continuously, adjusting prices based on, you know, order flows from clients. Who are the clients? The hedge funds, the MNCs, the sovereign wealth funds. Okay, foreign wealth funds is also another interesting topic. And also adjusting prices based on market making obligations, the central bank interventions. So it's just imagine tier 1 banks are the well of water, and every layer, the tier 2 to tier 5, tier 4, the brokers and us retails is just plumbing the connected downstream, okay. So on to the next, which is the hedge fund. So basically we all know, okay, hedge funds, they trade billions in FX, maybe not just in FX, okay, they trade index, you know, private equities, many other things, okay, but often it's a directional bet or it's just an arbitrage strategy, okay. So basically they use tier 1s, they use tier 1 banks as prime broker for execution, cleaning, credit and leverage, okay. So when a hedge funds unload billions, it forces tier 1 banks to rebalance liquidity, which then ripples down to your MT4 chart or your MT5 chart, okay. So arbitrage strategies, okay, if you know how some of the people does this, that's why it never works in the retail brokers, okay, in the tier 4 retail brokers, because the spreads, you just can't, okay. So that's why only the hedge funds or people who have this access to the tier 1 banks, they can do it effectively, okay. So that's why you see many, you know, financial figures went into problems or into jail because of, you know, this sort of issue, whereby, you know, sometimes the SEC needs to find a scapegoat for the KPI once in a while, you know, someone gets targeted. There you go. Okay, so just imagine, okay, the most famous story back in like 1992, which is, you know, the Soros Quantum Fund, okay, they shorted the pound through the prime brokers, okay. The prime brokers is basically tier 1, okay. So the pressure broke the UK out of the ERM, okay. Soros made 1 billion just on that day itself, okay. So one hedge fund flow and amplified by tier 1 banks can crack a central bank, okay. So maybe some of the secretive, one of a few hedge fund tactics is also like some funds specialize in sniffing out stop loss clusters, okay. The infamous argument between, you know, in traders, okay, about the stop loss, is there someone trying to find the stop hunt? It doesn't really matter, okay, but we go on and we can understand more in this manner, okay. So they lean on banks for data, the hedge fund lean on banks for data, and they push the size to trigger liquidity cascades, okay. So these are the desks that know where corporate hedges and retail stops overlap. So when that strike, it looks like a random spike on our chart, okay, but it was just engineered in upstream, okay, by these motherfuckers, okay, or these players, these big players. But the real game is actually hidden, okay, in private lines to tier 1 banks. It's not just liquidity, okay, it is leverage and shadow credit, or maybe invincible balance sheet that can move entire currencies overnight, okay. So it's basically how hedge funds actually plug into the tier 1 bank, and why this hidden pipeline can make or break some nations, okay. So hedge funds are marketed as, the geniuses within, secret algorithms, enigmas, BlackRock, So, but the truth is, most hedge funds, they don't have direct access to interbank forex, okay. So they have to rely on the prime broker, which is the tier 1 banks, JP Morgan, Citi, Goldman, okay. So these banks acts as a gatekeeper to the deepest liquidity pool, okay. So the hedge funds can't just place a 5 billion euro USD trade directly, okay. They need JPM, the warehouse, to net and clear that risk, okay. So without the tier 1 banks, hedge funds are just a big fish stuck in a small pond, okay. With them, they become sharks in the open market. So now it makes sense, right? So basically, the prime broker is more than just a service. It's also shadow lending. Okay, so tier 1 banks will just say, okay, we will extend your credit line. We will let you, use 10x, 20x, 50x leverage as long as you post your margin. Okay, so hedge funds don't keep billions sitting in cash. Okay, they run lean using credits from banks to amplify their bets. Okay. So this shadow credit system is invincible on the public balance sheet, okay? I repeat, on the public balance sheet. So a hedge fund can literally fund with a 200 million equity and can control 5 to 10 billion positions in FX daily, okay? Thanks to the direct credit liquidity from JP Morgan, and sort of tier 1 banks. So that's how a single hedge fund can look bigger than the GDP of certain small countries, okay? So tier 1 banks try to internalize flows for the hedge funds, the corporate, and the sovereigns fund, okay. Just imagine if hedge funds buy Euro USD and corporate sell, and a corporate sells Euro USD at the same time, then JP Morgan will net internally, okay, because there's no market impact. It's just pure profit on the spreads alone, okay. So, but if the hedge fund flows overwhelm and spill over hits the interbank forex market, that's when market move that violently, okay. Not because of retail, okay, but because banks can't contain the order flow. So it's just like the example, which is the hedge fund which short GBP during the Brexit votes. The banks try to net flow, but the imbalance is massive, okay. So resulted in GBP USD flash crash, triggered not by news, okay, but by unmatched flows leaking into the interbank FX market. So hedge funds exploit this structure, okay, because they know the tier 1 bank don't want risk. And if enough hedge funds pile into the same trade, the bank becomes a forced transmission belt, okay, forced transmission belt into interbank markets. So why this matters, okay, you ask, okay. Because as us retail, when we see price candles, hedge funds see balance sheets capacity at tier 1 banks. And if banks pull back credit line, hedge funds now string overnight. So liquidity vanishes, okay, no more. Say bye-bye. So example is during during 2008, the prime brokerage risk tightened, the tier 1 bank, their risk tightened, okay. So many hedge funds were liquidated not because their trades were bad, but because banks pull the plug on credit lines. So the real risk for hedge funds isn't the market turning, okay, it's their prime broker, tier 1, shutting the faucet, okay. So how this shapes today's market as a hedge fund, okay, the hedge funds, the tier 1 banks, is literally, the hidden shadow forex market, okay, that is kind of like fucking up our ass with heroin, okay. So basically, the macro hedge fund bets against yen during credit lines, okay. Tier 1 banks recycle this flow. And if Bank of Japan recedes too long, the imbalance grow, okay. Eventually, the interbank cracks, and then yen will collapse. So central bank monitor hedge funds, the SEC, positioning size through the tier 1 banks, which is the prime brokers, because that's where the true leverage hides, okay? So next time you hear about a hedge fund shorting a currency, remember they don't do it alone, okay? The real muscles come from tier 1 bank, the prime brokers, okay, who extend invincible credit and funnel trades into the interbank FX market. So that's the hidden pipeline, and that's the real hidden source or weapon, they call it, okay? The next, which is the multinational corporations, the MNCs, okay? These are like Apple's, Toyota, Shell. They move money not to speculate, okay, but to settle in trades. Okay, I repeat, to settle in trades. So these flows create non-speculative liquidity, sometimes countering hedge funds flow as well, okay? So MNCs often hedge futures exposure. Example like the airline hedging field in USD. So the automakers hedging yen, okay? So these hedges, forwards, contracts, swaps, and options clear through the prime broker, tier 1 bank. So the hedge funds are like the speedboats, okay, fast and aggressive. The MNCs are like the cargo ships, slower, predictable, but it's huge load of volume. Both enter the same harbor, the interbank market, okay? But the MNCs, the multinational corporations, they aren't the speculators, okay? They are just basically structural movers of currency. Why? For example, with Apple, okay? If Apple sells 10 billion worth of iPhones in Europe, revenue in euro, okay? So now it needs the USD back in the US, okay? So they have to call JP Morgan, okay? JP Morgan converts the billions of euro to USD. So that's a real forex demand, okay? Not a speculation. This is why currencies is not money, okay? So JP Morgan executes a multi-billion euro USD conversion in that manner. And maybe another example is like the airline and oil, okay? If airline hedge the jet fuel, which is priced in USD, okay, United States dollar, okay. A European airline buys fuels in futures in dollars, okay, and the hedges through the euro dollar exposure. That's billion in forward contracts, swaps, and options, okay. So these flows don't care about your chart pattern, okay. It's dumb as fuck, okay. They're driven by global trades. How does this work, okay? You will ask, do MNC really call JP Morgan for euro for cash flow? And yet, technically, the answer is yes, by that scale. So just imagine Tokyo or Toyota Japan sells 50,000 cars in euro this quarter, okay? That's billion in euro revenue sitting in European accounts. But Toyota, they have to pay wages, okay, suppliers and investors in JPY. So technically, they need to swap euro into JPY, okay? So this don't lock into the MetaTrader or routed to the Revolut, okay? They call their relationship banks, okay? So it's the tier 1 prime brokers, JP Morgan's, BNP Paribas, all these sorts, okay? So that bank will neither execute directly in the interbank FX market or internalize the trade, okay, if it has offsetting flow from another MNCs going the opposite way. So this is why tier 1 banks are crucial, okay? The MNCs, the multinational corporations, basically move massive real money flow tied to trade, okay, payroll and dividends and debt servicing. So these flows are sticky and predictable, okay? It's just, revenues, okay? And unlike speculative hedge fund flows, they create the underlying tide, which is in the FX market, okay? So now, on to the next, which is the tier 1 bank, okay? So tier 1 bank is the gatekeepers, okay? And we have already gone through a little example on the hedge funds and MNCs, how they use tier 1 banks as the gatekeeper, okay? So to summarize it short, is basically some key points you have to remember. It's just the internalization versus the passing to the interbank FX market. So just think of it as JP Morgan is the middle of the giant spider web, okay? So the client comes in with flow, okay? And the exporter A wants to sell euro because he wants to buy USD. And at the same time, an importer wants to buy euro and sell USD, okay? So there's a trade or there's a deal in the middle, okay? So this offsetting flows, internalization, which is JP Morgan matches those two opposite trades inside their own book, okay? So the exporter sells euro and the importer buys euro. So then in itself, it records both trades, okay? So no market risk, no slippage, just collect the spreads, okay? So this is perfect. Zero exposure, pure profit, okay? So the imbalance is technically meaning the leftover risk. What that means is, when the flow rarely match perfectly, maybe today, for example, 10 big corporations are all selling euro. because they want to buy USD, okay? So the JP Morgan can't find enough buyers internally, okay? So now the JP Morgan has to long USD or short euro. So that's a real risk, okay? So it hedges through the interbank right now as a tier 1 bank. So JP Morgan doesn't want to sit on this exposure, okay? They have to mandate this facilitation and speculation. So they basically offload excess euro or in USD into the interbank market with other tier 1 banks, other hedge funds or other multinational corporations, okay? So these are JP Morgans at that scale of tier 1, okay? So basically they're just, if they dump a big order, it moves the market price. So that's why large mismatch flows often, create spikes in euro and in USD, okay? Euro USD, for example. Okay, so the key insights here is just tier 1 banks, they aren't a gambler. They are basically the toll operator. They want flow and they want volume and spreads, but no risk, okay? So house of the house, guys. So internalization means the hidden invincible flow. You will never see them on charts, okay? So they are just passing on to the interbank, which is invincible. So now suddenly you feel it, you feel the volatility, okay? Your clique can feel the quantum price spiking up, okay? So when you see sudden Euro USD move, sometimes it's not the market deciding, it's just maybe JP Morgan or Citibank is dumping leftover exposure that they couldn't match internally. So tier 1, just remember, tier 1 banks don't want risk, okay? They want to internalize as much as possible. That's what hedge remains, okay? That's what hedge means technically. So on to the last, which is how it will hit us retails, okay? So by the time this price code reaches our MT5 or MT4, liquidity has already passed through tier 1, tier 2 regional banks, prime of primes, tier 3 brokers, ECNs, raw spreads, and until you, okay? So spreads has already widened, execution slows, and slippage occurs because you're at the far end of the pipe, okay? So your one lot order is irrelevant compared to billions flowing upstream, okay? But your stop orders are still data for brokers and liquidity providers to optimize risk. That is why there's A book and B books, okay? A book, if you wanna know more, just go back to the previous episode. A book, your trades routed up the chains. B book, broker take the other side because your order is too small to bother the big boys, okay? The big players. So connecting the hedge funds and the multinational corporations, and this is why it matters, which is hedge funds and MNCs are constant sources of order flow, okay? The hedge funds is basically speculative volatility, and the MNCs, multinational corporations, which is on the business foundational supply and demand. So tier 1 banks is the clearinghouse, okay, where it all balances, and the interbank is where the real battle of flow determines price, okay, because it never shows up on your chart. It never shows up on your chart, okay. So it's just like the gravity, price isn't moving because of your 0.5 lot trade, okay? It moves because giant upstream are exchanging in billions. So to wrap it all up, okay, onto the next episode, we are going over more into the central banks, okay? So when you see Euro USD spike, okay, so just don't think, it's just a retail stop hunts, okay? Maybe think it or frame it in this way, or now you understand why there's the role in hedge funds and the MNCs and the tier 1 banks, okay? Maybe is it the hedge funds is unloading their position, or is it Apple hedging against euro revenue, or is it because Citibank is passing unmatched flow into interbanks? So basically that's the real market you're trading inside, okay? 95%, the stats is real, okay? So in the next video, we'll just maybe go over, central banks in general, and then on to the next, which is government bonds, treasuries, and how literally the money actually prints into the market and how it is shaping the world, tariff, trades, wars. You heard me right, wars, okay? Because we are all aware that we are now in the intersection or or we are transitioning into a new phase of new currency structure or monetary distributions of systems, maybe, okay, like maybe stable coins, because 4 weeks ago maybe Trump is talking about it, maybe last week or this week the Central Bank of Europe is talking about it, okay? So it's actually pretty interesting at this time. So follow and subscribe. I hope that today you can learn something from the big players in itself. It's definitely something you have never heard of in between the Twitter space. You're all just trading prop firms, okay? Those spreads, those orders ain't fucking real, okay, guys? So So that's why, this game in itself is really, really, really difficult, okay? So on to the next. Charles.